Sentiment is one of the three key market return drivers we focus on in our top-down framework, alongside economic and political factors. We always go back to the framework pioneered by famous economist Sir John Templeton, that bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. During bear markets, the pessimism phase, investors tend to get very focused on short-term outcomes. Each new data point and news story can move markets up and down by several percent, and the world feels as though it's on a razor's edge. But zoom out. Does it really matter that much to the market 10 or 20 years from now if the weekly jobless claims number comes in above expectations today? The answer is generally no. And the rise in volatility around these events in bear markets is consistent with what we call, and what's been come to known as, myopic investor behavior, which we associate with deep pessimism. Counterintuitively, this phase of the market cycle often gives way to the best absolute returns of the cycle because pessimism and myopic investor behavior create a very low hurdle for economic reality to clear. As we evolve from pessimism into skepticism and eventually optimism, the classic wall of worry takes over the narrative. All of the yeah buts. The market is great. Yeah, but the weak manufacturing sector. The market is great. Yeah, but China's being aggressive in the Taiwan Strait. The market is great. Yeah, but inflation isn't falling quickly enough. Yeah, but, yeah, but, yeah, but. It's when you stop hearing so many of the yeah, buts that we reach that euphoria phase. In many ways, the opposite of where we began with pessimism. Instead of focusing so much on very short-term events, the market looks through potential bad news and assumes a very bright future. By our measures, market sentiment was most elevated historically in 1929, prior to the market crash and Great Depression, and in 2000, just ahead of the tech bubble. But even this euphoric phase can last for years and still mean strong forward returns for stocks. So here at Fisher Investments, we have many ways of monitoring sentiment. Our research group regularly collects data that tracks investor surveys, global investor positioning, capital markets activity, equity fund flows, valuations, and more. All of these is a way of measuring how sentiment is evolving through the cycle.